We also have a little bit of an alternative construction here. And we've already talked about it. We talked about it with the butterfly. I'm going to talk about it now with the condor. The short iron condor. We've heard about the short iron condor all the time, haven't we? Well, let's get into it. We said that in the butterfly, we were basically selling a straddle naked, which is not what we're allowed to do, but then adding a long strangle around it to protect ourselves in either direction. With the condor, we're doing kind of the same thing. We have an interior premium collection strategy that's short options, and then we are going to surround it with a long strategy that will provide hedging, provide protection. Here in the iron condor, instead of strangling the straddle like the butterfly does, we're going to strangle the strangle, because now we have an interior strangle, right? We split the strikes. We have a short interior strangle that's being surrounded by a long exterior strangle. The long exterior strangle is our protection, our hedge, while the short interior strangle is our premium collector. Because we would never be allowed to sell that strangle naked. We surround it with another strangle, a long strangle. So, what do we have? We're strangling the strangle. Theta of the short interior strangle is greater than the theta of the long exterior strangle. Are we giving up some of the profits that we could have made by just simply selling the strangle naked? Yes, but here's the thing, too much risk. Is it too much risk for a floor trader that's trading his firm's money and he's risking $500,000 and the account is $500 million? Come on. But you're not in that situation. The money you're risking is not your firm's, it's yours. And we can't allow that. That is just forbidden. See, what happens is, and I think I told this story already, most of the individual investors that I've come across that have had experience managing their own money, years before I even thought about teaching individual investors, they tell me that when they started off, the problem is that they never knew enough to not take the wrong position. It's not so much taking the right position. Sometimes you don't know enough to not take the wrong position. They said they were making money, everything was good, blah, 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 and then they tried selling a naked option. And sure enough, that one position wiped out everything they made for the past 7 years, and then some. The problem is that what I'm seeing with beginners is that they don't necessarily fail from day to day. They fail in one big shot. And that one big shot wipes them out before they can get to that point of knowing better through either education or experience. We want to eliminate the one big loss. If you can go through a career of trading without the one big loss here and there, you are going to wind up making a lot of money over time. And I mean a lot of money. Because it's the one big loss that sets you back gigantically. And then you struggle to build it back nice and slow, and you get back to that point where you say, oh, now I'm ahead, now I'm feeling good, now I'm a player, and kaboom! You do something stupid, and you take a huge loss again. And then you work it back with good win after good win after good win after good win, small, steady, and then kaboom, the big loss hits. If we can eliminate that big loss, then that slow and steady really adds up to something. Let's eliminate the big loss. We do not sell naked options, period. Don't care who tells you, oh, synthetically it's like this. I don't care. You don't sell naked options. Now, we've got the theta of the short interior strangles exceeding the theta of the long exterior strangle. That means that we have an overall positive theta. We're going to be bringing money in as time goes by. That is one way of looking at this iron condor. Strangle the strangle, two strangles. an interior short one surrounded by an exterior long one for protection. But we still have our two vertical spreads. In the call condor and in the put condor, we had two vertical spreads, one debit, one credit. The credit one always seemed to cost more, the debit one seemed to cost more than the credit one, thus basically having a overall debit trade, money going out. Here, all we're doing in the condor, just like the iron butterfly, all we're doing in the iron condor is we're grabbing that debit spread from the long call spread or the long put spread. We're grabbing that debit spread and we're saying, look, instead of using this debit spread in the call condor or the put condor, let's use our knowledge of synthetics. That debit spread actually has a synthetic equivalent, and that is short its opposite corresponding option spread. That means I can take this debit spread and replace it with a credit spread that's synthetically identical. Now I've got two credit spreads creating the iron condor as an overall credit trade. That's the only difference. That is the only difference. We yank out the debit spread in our conventional condors and replace it with its corresponding credit spread. And we've learned that in verticals. We learned that buying the call spread is the same thing as selling the corresponding put spread. So what they're doing here is they're looking at that buying the call spread in your long call condor and saying, hell, why am I going to buy that call spread when I can sell the corresponding put spread? And they're just switching them out. Now I've got two credit spreads. The one that was going to be in the condor to begin with, and the replacement for the debit spread that I've yanked out of my conventional condors. But I still have two conflicting spreads, both converging on the same area. We have two converging credit spreads. Again, we have the June 65-70 condor on the left. Now we're going to break it down into two vertical spreads. What you're going to see different is not what you think I'm going to say. I want you to be thinking about your conventional call condor and your conventional put condor. It works the same for the iron butterfly versus the regular butterfly, but I want you to see it with the condor. What we have here is if we had the regular condor, we would be long a vertical spread and short a vertical spread. A debit spread and a credit spread. Buying one, selling the other. Money going out in one, money coming in the other. That created for us a total debit trade. The conventional call condor, the conventional put condor were debit trades because our long spread cost more than we brought in from the sale of our short spread. The way the iron condor is constructed, what we do is we take that long vertical spread and we replace it with its short corresponding vertical spread, its synthetic equivalent. So take a look now. Look at your put spread. Short the June 65 put, long the June 60 put, that's a credit spread. The June 65 put is more expensive than the June 60 put. You're selling the more expensive one. You're buying the least expensive one. You've got a credit here. The difference now is the fact that you've also got a credit in this other spread in the iron condor. Short the June 70 call, long the June 75 call. You are short the more expensive call, long the cheaper one. That's a credit also. The trades are still synthetically identical, the conventional condors and the iron condor. We just took two credit spreads instead of one debit, one credit. That's all that happened. It really is that easy. So we just substituted our long spread that we have in the conventionals with its short corresponding spread. They're both synthetically equivalent. They both make and lose the same amount of money at the same place. Their Greeks are identical. So what do we have? We just have a simple replacement of our vertical spreads. Long the call spread equals short the put spread. Instead of putting a long call spread in there, we put another short put spread in there. That's all. Now, their values must be equal, right? Got to have equal values if they are truly synthetic. Let's take a look. We did this a couple slides ago for our long call condor and our long put condor. We showed them both to have identical risks, identical rewards at the same prices. Obviously, you already know that this one's going to work, but let's go through it. We're going to buy the June 60 put at 6 cents. Where's the stock? Right, 67.50. We wouldn't have done the condor if the stock wasn't between the two strikes. If it was right at the strike, we would have just done the butterfly. We sell a June 65 put for 77 cents. We sell a June 70 call for 87 cents. And we buy the June 75 call for 12 cents. Now, our total credit is bigger than our total debit. The money coming in from sales is now larger than the money going out from purchases. What's the credit we receive? Add them up. Add 87 cents plus 77 cents minus 12 cents minus 6 cents. You've got $1.46 credit. Your maximum profit then must be $1.46. Why? Because you can only make the amount of money that you brought in from the sale when you sell something. Wasn't our maximum profit in the call condor and the put condor $1.46 too? And what's our maximum loss? $5 between them, $5 max, $5 minus $1.46. What's that, $3.54? Check that against the total maximum loss in your call condor and your put condor. They match identically. They are all synthetically equal. Now, obviously we've talked twice now about the type of chart patterns we want to use for a delta neutral premium collection strategy. We know that we want a consolidation. We want a sidewards trending market. And what we're going to do now is we're going to take a look at how we find that type of sidewards trending market. There's the condor.
Very good, very good. You're showing people how to profit from the most boring situation in the world.
Well, you know what? It's boring when you're looking at it, but as you start looking at your account, it becomes a little more exciting.
It's boring when you're paper trading.
Oh yeah, well there's no real profit there, but you know it's funny because normally somebody who's coming from the stock market, you know, they're banging through their charts when they see the pattern that you're about to show them. They're just going to go right past it as if there's no opportunity there.
Right.
And little did they know that if they understood options and went through and all the premium collection strategies like the condor and the butterfly before it, they have plenty of opportunity in that charting pattern. They just don't know it.
That's right. I mean, people that come over from the stock market think that there's only one or two ways to make money. Stock moves up, stock moves down. When I see a consolidation pattern, I get really excited because I know trading options that you can bank some pretty big bucks off of it.
Yeah, I mean, you're not going to become rich in any given month, but over a long period of time, premium collection starts adding up because of the compounding. The compounding rule, the rule of compounding.
Right. Well, you know what happens is, in the stock market, like I said, only moves up or it only moves down. So, you sit there and you search and you screen and you search some more to try to find a potential breakout or a potential breakdown. But when it comes to this strategy, you're talking about consolidation, and they're all over the place.
Yeah.
So you can really pick and choose which ones look perfect to you, and you don't really, you don't tend to go out on a limb like one would when they're looking for a breakout or a breakdown to play. They basically find these consolidation patterns all over the place.
And guess what we're going to have you go do?
Find another consolidation
Well,
pattern?
they're all over the place. If they go find one.
There's one right there.
There's actually two over there, but that's beside the point.
Okay.
But what we need is we need a consolidation. And the thing that I want everybody to focus on while Chris shows you how to find a consolidation is you want to focus on finding it early. So what you got to do is give these people the time to find it early.
Right. Like we said in the butterfly, you know, if you get into the consolidation pattern too late, keep in mind that the longer a stock consolidates or the longer the stock builds a base, the bigger the breakout or the breakdown tends to be. So just remember, when you're getting into the consolidation pattern, you want to get in nice and early, especially after a breakdown, because after a breakdown, volatility in options tends to explode at that point in time. So what you're doing is you're shorting volatility, you're bringing in that extrinsic value, and as soon as the stock calms down and levels off, all of that shrinks. And remember, you're basically shorted volatility at that point. So you're buying it back cheaper, which means it's a big profit to you.
Well, then all we can do is send you off to show us a situation where we can apply the condor, which is a consolidation. Make sure you find an early one this time. Make it good.
Okay.
For them.
Okay.
Okay?
I'll be right back. Okay, what we have here is Biogen. Now, what we're looking for is a consolidation pattern, and the consolidation pattern is typically the best time to find the consolidation pattern is right in the middle before it's obvious to everybody else. Because you're profiting when the stock is consolidating, and if the stock breaks out, well, then you're going to have to adjust your position. You're probably going to be taking a little bit of a loss. And when you have a breakout after a long base like this one, for instance, if you caught this at the end, the longer the base, the bigger the breakout or breakdown typically is. Okay, so you want to find it nice and early, especially the fact that you're shorting volatility. In this case, you want to find it after people are panicking and it's crazy and you see these huge price swings, okay? So we're going to identify the key price points just like we always do. Stock tanked from 70 all the way down to about 50, and then you can see that, every time we find one of these little trading ranges, the support levels are broken. So we're going to remember these major key price points from this chart, and we're going to zoom in a little bit to a daily chart. Remember, we have 45, we have 50. We're going to zoom in. All right, right here you can see at 47.50, there was some resistance found here, here, and here. Now we're going to extend that line out, and typically once resistance is broken, it becomes the new support level. Now, we're looking for a consolidation, so we're looking for some indecision. Now, we see that we have a breakout here, but the breakout is not on very huge volume. Besides, you can see all these other big, or relatively big volume days when compared to this up day. You see all red bars. That means this is down volume, down volume, down volume. Whenever you see up volume, with the exception of this one day when we attempted to break out, the green bars are pretty small. So you have low upside volume and big downside volume. But you can see that the stock's obviously trying to do something. So it breaks out, or at least it attempts to break out, just not on impressive volume. And so we remember that this is a resistance level that should become the new support level. You can see the stock starts to consolidate. We're going to get into a couple of other clues. Let's zoom in right here. The other clues are candlestick patterns that you see. Now, what you see in the candlestick, if you understand candlestick charting, you see some indecision here. When you see big wicks, these look like candlesticks, and the big wicks are on either end called upper shadow and lower shadow. You see these small bodies right in the middle. That means indecision. Okay, so you see a lot of that over here. Very small bodies, very small trading ranges even, the intraday high and the intraday low. But from the distance between the open and the close creates the body. And you can see that pretty much every day here it closed right around the same level that it opened, or there are many of those days. You also see a lot of bearish, they're the reversal of a bullish trend. Bearish candlestick patterns, inverted hammer. It looks like an upside down hammer. 1, 2, 3. I can count a whole bunch of them. And you can see that there's a doji here too. So you find all these little tiny clues right around the same price point. All these different candlesticks are telling you there is indecision. You can learn more about this at the Internal Strength System, my technical analysis study course. But this all says indecision right at this level of resistance. However, the stock doesn't tank. It doesn't drop at this level either. You can see one day they tried to drop the stock all the way down to this. It opened up this low. It's a green candlestick, so that means that it opened here and closed at the top. This is an up day. Now you can see, now it looks like there's down volume here, but this volume is based on the difference between this closing price and this closing price. So you had this closing price was a little bit higher than the next day's closing price. That's why it's a red, bar for it indicates down volume. However, what happened was it opened all the way down here and made its way all the way back up here to the same key price point. So what you see here is some indecision. Now, this might be a little bit confusing. You might be a little bit aggressive and say, well, this is where the consolidation is going to happen, and this is where volatility is the highest. I want to short it. or you can wait a little while and you want a little bit more confirmation of what's going on here. You can see that the market, they tried to knock this down below this point of new support and old resistance, and they just couldn't do it, even though they had all this volume. So there's a big battle going on. So say you're a little bit more conservative, you want to wait a little bit. You see that there's some indecision right here. You know this because you identified a chart formation. That's a symmetrical triangle. Now, typically what you see right around here in a symmetrical triangle is a big breakout or a big breakdown. You see nothing. Nothing happened. There's lots of indecision in these candlestick patterns. There's hardly any volume right here. And it's the last few trading days of the year. If you understand seasonality, you understand that this is probably the most quiet week of the entire year because everyone's on vacation and celebrating holidays and things like that. So what you do is you have a pennant or you have a symmetrical triangle, depending, it's kind of in the eye of the beholder. It's subjective. You don't have any breakout either way. So you know there's indecision. You know this is a key price point, old support, new resistance, new support again. So you can see right at the end of the year, there's almost zero volume there when all this is happening. So you have erratic behavior right here, heavy volume, which means options are very expensive. You implement your strategy when options are very expensive. You take advantage of the volatility. You're shorting fear, and you're able to actually buy it back, exit the position right here, and that's how you implement that strategy. That's how you find yourself a nice consolidation pattern, and that's how you short volatility.
To see how Ron selects options that match Chris's strategy, visit the members section at optionsgps.com.
Hey, thank you very much. That was excellent.
Yeah, well, it wasn't easy. I try to take something that normally is very boring to especially people coming over from the stock market and try to make it exciting, a consolidation pattern. Ooh, sideways trend.
You know what? Where the excitement should be is finding it early. Because as you know, and you've stated before, that if you could find it early, you're probably coming out of a period of time that was just very volatile. So
Right.
Volatility should be up, prices should be up, and since we're collecting premium, that's a perfect time to throw a condor on.
Yeah, I mean, what happens pretty often when it comes to people looking at charts is they lose all perspective of time. So you might look at a chart that's a one-year chart, and you're waiting for the stock, and you think it's going to bounce off of a certain point, and you look at it 3 times a day to see if it's happened yet. But, you know, it might happen over the course of a month or over 2 months. So you lose perspective in terms of time. So, and also people tend to jump the gun because they see a price pattern forming. And what they do is they jump onto it, way before it actually confirms that it is in fact a channel, and confirms a resistance level or a support level. And you don't have to do that. So just keep that in mind when you're looking at a chart. Don't lose perspective of time. Remember that this little period of time right here is actually a month, and you don't want to jump the gun, and you don't want to, you also don't want to jump into the condor too late in the consolidation pattern, because like we said with the butterfly. When you have a long consolidation, the longer the consolidation or the longer the base, the bigger the breakout is to the upside or the downside if you're wrong.
One of the things that I like about the condor and the ability to make money when the market goes sideways in the options market is if you ever watch a stock trader, they go through charts and they're banging through charts, and what are they saying? Not this one. The
Right.
stock's going sideways. Oh, look, now this one's not moving. This one's not moving. They go through 19 or 20 different things that aren't moving as if there's no opportunity there.
And they want it so bad they force the trade. They say, well, this one looks good. It's not exactly what they wanted, but they'll take it because they want to make money because they feel like all these sideways patterns they can't profit from, right?
And you just said that, sideways occurs more often than not. And if that's true, then we have plenty of opportunity to actually make money with off these charts that everybody else is bypassing, which means that we have more opportunity.
So basically all we have to do, especially after a stock tanks, is just find the key points, the key price points that everybody else knows about, the support and resistance. And see a stock tank, people are running around with their hair on fire, and they're puking up stock. You got somebody else in there buying all that stock from them. You see huge volume. And then what you see, you establish this channel that we found with key resistance points and key support levels. And once the stock happens to find its way into that channel, immediately what you'll see is volume dry up, especially when you get near that resistance point, because the buyers are just stepping back, saying, I'm not even going to touch it near that resistance point. And then you wait and you see the volume dry out, and immediately you put on your condor and you start taking advantage of shorting volatility.
It looks boring, and I'm sure a lot of the stock traders out there are saying, oh, God, that's, those patterns, I hate those patterns. But you know what? If you're able to make money in these patterns, then all of a sudden things become a little more exciting.
Well, when you're shorting volatility, remember what you're doing is you're shorting fear, and to me that's exciting. You're shorting fear. How many times have you been the one who's, let's just say you have all your money on the side, you don't happen to be in the stock market when it crashes or takes off, but you sit back and you kind of see people acting crazy. Wouldn't you love to go in and just short that craziness? You're selling it. You know at some point it's going to die down.
Sure.
And that's why most of the time you have the consolidation patterns, because most of the time everybody's calm. So when everyone's nuts, it's the, one of the best bets on the street that you can make is you're shorting their fear, you're shorting their excitement. I wish I could do that in places outside of the stock market.
Yeah, no kidding. But the thing is, we do know that at some point in time the consolidation runs out.
Right.
And we are going to get a directional movement out of this. And one of the nice things about the condor is, it's got a very simple morph, which will allow us to easily jump out of that non-directional condor into a directional trade, a vertical spread. Because when you break down the condor, like the butterfly, yeah, it's a strangle surrounded by another strangle, but it's also two different vertical spreads if you break down, break it down a little differently. And there's a bear and a bull. And use the one that works.
Right. So you basically are playing the bull side and the bear side when you're taking in premium. And then if you see a breakout or a breakdown out of that channel that we established, all you have to do is eliminate one side of it and you start making money.
Let me show you how you do that.
All right, let's do it.
Well, that now we've reviewed how to find a sideward trading consolidation, let's take the next step. Now that we've identified our opportunity, it's time for us to initiate our strategy. So the setup, we found the consolidation pattern and we asked ourselves, hey, should we trade this pattern? And we decided, yes, we're going to use some type of delta neutral premium collection strategy. And when we looked at it, we saw that the stock was between two strikes. So we were first thinking butterfly, but with the stock between the two strikes, we've decided to opt for the condor. So we're going to go ahead and trade the condor. We could have also identified a pattern of the skewed volatility smile. The smile might have been too peaked, or it may have been, what? Too flat. And knowing mean reversion, we would have the smile flatten out if it's too peaked, peak if it's too flattened, and we would have used our condor. So we also have one other potential. Let's say we were already in a spread, a vertical spread, and now we've identified the consolidation. Then we could leg in by what? Doing the other vertical spread. So what are our keys to success here in our condor? Well, obviously, sound technical and fundamental analysis of the stock. We have to have a stock that's trading sideways for a condor to really work for us. If we know and we properly identify a stagnation period in time in the stock, we will have success using condors on a regular basis. If we're having trouble and we find a stock that we thought was going to consolidate, a stock moves, then we're going to wind up seeing our maximum loss potential. Remember, premium collection is all about theta and the decay of extrinsic value. That's the key. We are in a delta neutral position because we're not trying to trade stock movement. We are about collecting premium. And in order to collect premium, using a delta neutral strategy, we've got to find that opportunity of the sideways trading pattern, and we've got to make sure that as premium collectors, we're selling the at the monies. Also, know that you can break down your condor as a combination of two vertical spreads. Although you could look at the iron condor and say, hey, I could also break it down to a long strangle that's around a short interior strangle. Yes, you can. But when it comes time to morph, if the stock starts to move, you've got to be able to mentally visualize the condor as two separate vertical spreads, a bear spread and a bull spread. Finally, you need to know that the long call condor, its corresponding long put condor, and its corresponding short iron condor are all the same trade. They are synthetically equivalent. They are identical in every way. And of course, theta is the key here. Know thy Greeks. Now, we've got our condor on. What are we going to do next? We've got to manage it. Don't think for a minute that just because you've identified a period of stagnation, that period is going to last for as long as you need it. It doesn't sit there and say, hey, I'm trading sideways now, and oh, gee whiz, Bob needs me to have, to trade sideways for another 2 weeks until his condor expires. No, sometimes things happen when we're not ready for it. And that means we have to understand how to adjust this position to avoid that maximum loss scenario. So what if the stock goes up? What if we're in our condor and the stock goes up? Go back to remembering the condor is what? 2 vertical spreads, a bull spread and a bear spread. Whether we're looking at the call condor, the put condor, or the iron condor. They have 2 things about them that are consistent throughout. A bull spread combined with a bear spread. And that's what we need to remember when we're morphing. We need to remember we've got a bull spread and a bear spread. If the stock starts to go up, we know our bull spread would be working for us, but our bear spread is hurting us. What can we do? Take the bear spread off. Take it out of the picture and ride the bull spread. I also have another little morph we talked about in the butterfly, which is a little more aggressive, and we'll take a look at that. Remember, the other thing is, too, if it's not working and you're in doubt, you can always get out. You can always close. So here we are in our call condor. We have a bull spread and a bear spread with the stock going up. What do? Obviously, we want to get rid of the bear spread. And we do. We simply take off our bear spread and ride our bull spread. And now that we are in a vertical spread, forget about the condor. It's done and gone. Trade this position now. If the stock continues up and heads toward breakout, review your morphs for vertical spreads. If it heads for breakout and we're along the call spread, now we're going to buy back the short call and ride the long call in stock replacement mode. What have we done? We started with a condor. We picked up a little movement, so we went to a bull spread. With that little movement turned into big movement, we went to stock replacement. If we're in our put spread, we're going to do the same thing. We're going to remove our bear spread and keep on our bull spread in our put condor. Boom, now we're riding the stock up. That's what we want to do. If we're in the iron condor, and as you notice, all of these morphs are just like the butterfly's morphs. If we're in an iron condor and we look at it real quick and we say, oh, stock's starting to run. Even though these are both credit spreads in the iron condor, remember in the put condor and the call condor, we had a debit spread and a credit spread. One bull, one bear. In the iron condor, they're both credit spreads, but there's still a bull and a bear. Stock's running up. What do we want to do? Get rid of the bear and ride the bull. What if the stock goes down? What are we going to do now? Well, in the same way the stock was going up, the bear spread was hurting us and the bull was where we wanted to be. The opposite happens here. The bear spread's helping us, and the bull spread's in our way. We want to remove the bull spread and ride the bear spread. Here's our call condor. 2 vertical spreads, a bull and a bear. Get rid of the bull, ride the bear down. Now that we're in a bear spread, remember your vertical spread morphs. If the stock is going down, remember what you need to do. If the stock picks up steam on its way down, breaking a support and turning into a breakdown, we're going to morph our vertical now into stock replacement. Here we are in the put spread. Stock is trading down. We've got a bear spread and we've got a bull spread. Get rid of the bull spread, ride the bear. Here we are. We're now in a bear spread. The stock is trading down. It comes to a level of support. It breaks support. Now we're in a breakdown. Do we want to be limited by our new position, the vertical spread? No. We want to morph that into what for the breakdown? Stock replacement. Buy back that short put, ride the long put. What we're doing here is we're going from strategy to strategy. As you're changing from one strategy to another, the previous strategy now has to be gone and done. Out of your head, out of your mind totally. You now have to trade what you have. Now, I was in a condor, now I'm in a vertical. I'm in a vertical and a situation occurs, the pattern changes. Now I've got to get out of my vertical into a stock replacement. The moment I'm in stock replacement, I must remember all my rules for stock replacement. Skip the vertical, skip the condor. Stock replacement, we're in the right direction, we're long a put, we're rolling down with the breakdown. Here's our iron. Again, the iron's got 2 credit spreads, but it's still a bull and a bear. Get rid of the bull spread, ride your bear spread. What if the stock stays still? What if the stock just goes sideways? Well, isn't that what we want? Isn't that why we put this trade on? We identified a consolidation, a stagnation, a sideward trading movement. Well, if it's doing exactly that, don't do anything. If you're in a call condor and the stock's doing what we want, stay in the call condor. What's that old saying? Don't fix what ain't broke? Well, don't fix what ain't broke. Leave it alone. Our put condor, same thing. We know our morphs. We know what we're going to need to do and what level we're going to need to do it at. But right now, ride the position. Remember, the call condor, the put condor, and the short iron condor make more money quicker the closer you get to expiration. If you have an opportunity to ride this thing straight into Friday of expiration, do it. That's where you make the most money. So when you're thinking about premium collection, delta neutral, and you got butterfly in your mind, and you look at the stock and you say, oh, wow, the stock's between 2 strikes, we go with the condor. And also, don't forget, if you're a little risk averse and you like the idea of the butterfly, but you're a little nervous about the fluctuations of the stock in your center strike, go with the condor, spread your strikes out. You're going to make less, but you're going to feel better about doing it. And with the more experience you get with the condor, you'll work your way into that butterfly at some point in time. No rush. So that's it with the condor, and hopefully you'll be trading a lot of condors and generating income in the near future. Well, that was the condor, our last strategy here at Options GPS.
Great job.
Well, thank you very much.
Yeah, thank you very much for the performance and keeping it interesting and exciting. And a special thank you to all of our students at Tycoon U.
You know, we know you're excited to start applying this knowledge, and we want you to know that this is not the end. We're going to be there with you as you take those next steps toward your financial freedom.
Right. Just remember, take your time, be patient, and know that you have some resources available on the website at optionsgps.com. Even though you've completed the course, we're still here for you. So from all of us at Tycoon U, thank you, congratulations, and we'll see you online at optionsgps.com.
Here we have the Condor. Chris had selected BIIB, Biogen. Now, here's the thing. As you noticed, both the stock that he chose for the butterfly and the Condor had the same charting pattern. They were going sideways, a sideways consolidation. Now, why did one of these stocks conform to a butterfly and the other to the Condor? Very simple. Where was the stock price? As you remember, in TEVA, what did we do? We had a stock that was trading right at the strike. If it's trading right at the strike, we can go with the butterfly. It'll be delta neutral. But here, in this example with Biogen, look where the stock is, 47.05. Well, heck, that's right in between the 45 and 50 strike. If we try doing the 45 butterfly, we know that we'll wind up long delta because the 45 calls will have a lot more positive delta because they're in the money than the 45 puts would. If we did the 50 butterfly, the opposite would happen. Our 50 puts would have a lot more negative delta than our 50 calls, creating a short position. So what do? We do the Condor. Stocks in between the strikes, we don't do the butterfly, we do the Condor. Stock at 47.05, we're going to wind up doing the Condor. So, how are we going to create it? First way, let's do the all call, debit trade, all call Condor. We are going to first buy the Jan 40 call, $7.70. We are also going to buy the Jan 55 call for 35 cents. Now for our short options. There's two of them in the Condor, not just one. We are going to sell one of each, the Jan 45 call and the Jan 50 call. Both of those strikes are straddling the current stock price. That means that 47.5 being between those two strikes, we're going to sell one of each of them. There's your call Condor. Now let's take a look at a put Condor because we know we can reconstruct this by using all puts. Got to be corresponding. We are going to buy the Jan 55 put, currently offered at $8.40. We're also going to buy the Jan 40 put, offered at 60 cents. Now we've got to sell our two at-the-money options. And with the stock at 47.5, both the 45s and 50s are at the money. We're going to sell one of the Jan 45 put for $1.45 and one of the Jan 50 put for $4. That is, again, going to create a debit trade. Both the call spread, the call Condor and the put Condor are both debits. We've got to pay out for that. But that doesn't mean they're not premium collection, remind you. One other way of setting this up, we could always go iron if we want to get the credit. So if we go iron, now we have to look at this strangle, the Jan 45-50 strangle. That's what we're going to sell. Remember in the Condor, we've got to strangle the strangle. Our interior strangle, the one we're going to sell, is the Jan 45-50. The strangle we're going to buy around it for protection is going to be the Jan 40-55. So let's look at it. We are actually going to go out and sell the Jan 50 call for $1.05. We are going to sell the Jan 45 put for $1.45. Now we need our long strangle around it. We got to strangle our strangle here. We are going to buy the Jan 40 put at 60 cents to protect against an adverse movement in the stock, which would, of course, hurt our Jan 45 short puts. And we're going to buy the Jan 55 call at 35 cents in order to protect our short Jan 50 call. In this way, we have now the iron Condor, a credit trade. But we don't just do the iron because it's a credit. We have to look at all three. They're synthetically equivalent. We look at all three and figure out which one gives us the best effective price. If they're all equal, by all means, do the one you want. I don't care. But if one of them gives you a price advantage, by all means, take the cash and do the best one that gets you in at the best price.